On the 15th of August, 1971, the President of the United States appeared on national television and made an announcement that would, in a structural sense, alter the foundation of global finance. He did not declare war. He did not announce a recession. He did not introduce a new currency. He simply said that the United States would suspend the convertibility of the dollar into gold. 30 seconds of carefully measured language. The press called it a temporary measure. Most Americans watched the announcement and returned to their evening. But something permanent had happened. For the first time in the modern era, the world's reserve currency was backed by nothing except the continued willingness of nations to accept it. Gold, which had anchored monetary relationships for centuries, had been removed from the architecture of global exchange. Not gradually, not through negotiation, through a unilateral decision made over a weekend, with no prior consultation with allied governments. What followed was not immediate collapse. What followed was a structural reorganization of global finance, so profound that its consequences are still embedded in every central bank balance sheet, every reserve currency relationship, and every sovereign debt market operating today. This is historical capital. Today we examine how the removal of gold from the international monetary system in 1971 reshaped the structure of global capital, the logic of sovereign debt, and the architecture of trust that underpins modern money. To understand what changed in 1971, it is necessary to understand what the system had been. In July of 1944, representatives of 44 allied nations gathered at Bretton Woods, New Hampshire. The objective was to design a monetary architecture that would prevent the competitive devaluations and financial instability that had contributed to the depression of the 1930s. The system they constructed rested on a clear hierarchy. The United States dollar would serve as the world's primary reserve currency. Participating nations would peg their currencies to the dollar at fixed exchange rates, and the dollar itself would be convertible into gold at $35 per troy ounce, redeemable by foreign central banks and governments. Nations did not need to hold gold directly. They held dollars, and because dollars were convertible at a guaranteed rate, those reserves carried the credibility of metal without requiring every country to manage a physical gold stock. The United States, holding the largest gold reserve in the world after the war, became the guarantor of the system. For the first 2 decades, the arrangement functioned with reasonable stability, but the architecture contained a structural tension that would prove irresolvable. The problem was identified with precision by the Belgian economist Robert Triffin in 1960. His analysis described a fundamental contradiction embedded in any system where a national currency serves as the world's reserve. For the global economy to function, it requires a constant supply of the reserve currency. The only reliable mechanism for supplying dollars to the world is through persistent American balance of payments deficits. But persistent deficits accumulate claims against American gold reserves, and American gold reserves were finite. In 1945, the United States held approximately $20 billion in gold. By the late 1960s, that figure had declined as European economies recovered. The Vietnam War generated fiscal pressure, and American dollar liabilities held abroad expanded considerably. Triffin's conclusion was stark. The system could not be sustained. The question was not whether convertibility would end, only when. By the late 1960s, the structural weakness had become visible to those positioned to act on it. France, under President de Gaulle, began systematically converting its dollar reserves into gold at the guaranteed treasury rate. Other nations followed. The London Gold Pool, a cooperative mechanism among 8 central banks to stabilize the gold price, came under sustained pressure. In March of 1968, a speculative run forced the closure of the London gold market for 2 weeks. The pool disbanded. The fracture lines were becoming structural. Simultaneously, domestic pressures were intensifying. Combined expenditure on the Vietnam War and Great Society programs had expanded fiscal deficits. Inflation was rising. The dollar, pegged at fixed rates, was becoming increasingly overvalued relative to what market forces would have assigned. By the summer of 1971, the situation had reached an acute phase. On the 13th and 14th of August, Nixon gathered Treasury Secretary John Connally, Federal Reserve Chairman Arthur Burns, and key advisors at Camp David. The options were limited. Suspension of convertibility was framed as a temporary technical measure. On Sunday evening, August the 15th, Nixon announced the suspension. He did not consult the International Monetary Fund. He did not notify allied governments in advance. The Bretton Woods system, which had governed international monetary relations for 27 years, ended that evening. The short-term consequences unfolded rapidly. Without the gold anchor, the dollar fell against European currencies and the yen. Negotiations at the Smithsonian Institution in December produced revised exchange rate agreements. Nixon called it the most significant monetary agreement in history. It lasted 14 months. By March of 1973, coordinated currency pegs collapsed entirely. The world moved to generalized floating exchange rates. The era of fixed exchange rate discipline had ended. Gold, freed from its $35 ceiling, rose sharply. By January of 1980, it reached $850 per ounce. Those who held metal preserved purchasing power through a decade of inflation. Those who held a dollar-denominated fixed income assets experienced significant real losses. The deeper consequence was structural rather than cyclical. What the Nixon shock actually changed was the foundational logic of money itself. Under Bretton Woods, dollars were claims on a physical resource. Their credibility derived from the convertibility mechanism. Excessive money creation risked triggering gold outflows. That constraint imposed discipline. With it removed, money became a pure institutional arrangement. Dollars derived their value exclusively from the government's promise of acceptance, the enforceability of dollar-denominated obligations, and the Federal Reserve's capacity to manage supply with sufficient discipline to maintain purchasing power. The flexibility gained was genuine. The Federal Reserve's response to the 2008 financial crisis, expanding its balance sheet from approximately $900 billion to over $4 trillion within 4 years, would have been structurally impossible under gold convertibility. The system traded one form of constraint for another. Gold's constraint was geological. The new constraint was institutional and behavioral. The dollar retained its reserve currency position not through formal agreement, but through structural inertia. Oil was priced in dollars. International bond markets operated in dollars. Central bank reserves were held predominantly in dollar assets. The dollar's position became self-reinforcing through the depth and liquidity of American financial markets, rather than through a gold guarantee. The precedent set in 1971 reverberates through every subsequent monetary arrangement. When a government faces fiscal pressure and monetary constraint, the historical record suggests that the constraint yields before the pressure. Philip IV of France debased his coinage in the 14th century to manage war expenditure. Roman emperors reduced the silver content of the denarius to cover imperial costs. In 1971, the world's most powerful government suspended the one mechanism that limited its ability to finance obligations through monetary expansion. Sovereign debt markets expanded dramatically after 1971. Without the discipline of gold convertibility, governments found borrowing more accessible. The accumulation of national debt that characterizes the early 21st century is in part a consequence of that removal. Global debt to gross domestic product ratios have expanded consistently since the early 1970s. Central bank balance sheets have grown in scale and scope. The system has demonstrated remarkable resilience. Its resilience derives from the same source as its vulnerability: the willingness of global capital to accept dollars and the institutional credibility of American monetary management as the foundation of international financial order. That credibility is not backed by metal. It is backed by depth, by legal structures, by the absence of alternatives sufficiently large to absorb a reallocation of global reserves. In 1971, gold was removed from the architecture of global money. What replaced it was a more complex arrangement built on institutional credibility, market depth, and the structural incentives of a deeply integrated financial system. That arrangement has governed international monetary relations for more than 5 decades. Its stability has never been guaranteed. Its longevity has depended on conditions that are themselves subject to change. The structural question that Bretton Woods asked in 1944 was how to build a monetary system capable of sustaining global commerce. The answer lasted 27 years. The question that August of 1971 opened remains, in a meaningful sense, unanswered with the same finality. When the architecture of money changes, capital reorganizes around the new structure. When trust substitutes for metal, the quality of institutions becomes the margin of safety. And once the anchor shifts, the question is not whether the system holds. The question is what it holds on to.
If you're interested in how power actually works beneath the surface, subscribe, support the channel with a like, and let me know below which historical pattern you want explored next.